Now, CPI coming up from Australia. We briefly touched on CPI in Swiss, but again, very little change in your headline print. A rise from 2.1 to 2.2. CPI, by the way, is your consumer price index. So it looks at the change in price of goods and services. Now, travel, education, hospital costs, they're all just some examples. The previous print, so click on that folder again, we saw inflationary numbers remain unchanged, 2.1, despite analysts expecting a fairly modest increase to 2.5. This time around, headline inflation, when I'm saying headline, this includes all goods and services, not your core element, which excludes the food and energy sector. But yeah, a modest increase of 2.2%, despite inflation still being low at that target range of 2%. There are still some fairly big concerns in regards to the growth of the overall economy in Australia. And this is shown by the fact that the RBA, the Reserve Bank of Australia, are pricing in interest rate cuts it can potentially happen in February, but potentially in May. So still a fairly sticky area. But if we see a number, or if we see an actual print, which comes in above 2.2%, that's when you would expect to see the Australian dollar strengthen on the back of that. Inflation is still a potential concern. If inflation falls, or your CPI figure falls below 2.1% within, let's say, 1.9, 1.8%, then the Australian dollar is likely to weaken off the back of that. So that's where you'd see, generally speaking, bearish sentiment in the Australian dollar. It's not always going to happen. It's just a general guide. There are going to be some potential underlying factors which drives price either to the upside or downside. But it's a general guideline.